First, I want to wish everyone a happy new year. I want to thank all of my colleagues, friends, associates, business partners for being here today. 2021 is going to be a very busy and active year. We're looking, we have a lot of clients that have been sitting on the sidelines waiting to see what was going to happen politically, waiting to see what was going on with COVID and everything else. And with that, we anticipate a lot of activity. We enjoy our partnership with John Hancock as they are cutting edge for our high net worth clients. They're cutting edge in many ways. One is that they have socially recognized that people take care of themselves with their health, and they've done major advancements in this vitality program where people take care of their health. They've also been very proactive with diabetics across the country with a program they have called Aspire. And of all the insurance companies we represent, I have to tell you, they have taken the most active role in being cutting edge from not only an underwriting perspective, but a product perspective. In addition, when dealing with high net worth clients, the main thing that one has to consider is, where's the company going to be 5 years from now, 10 years from now? What's the financial strength of the company? Now it's never more important than ever that we take recognition of the fact that Hancock has tremendous financial strength, has tremendous retention in their life policies, has their own underwriting manual as opposed to using a general underwriting manual like other companies. So much more I have to say about the value of the relationship. One of the things I realized when I was up in Boston is, unlike other insurance companies that manage just their fixed portfolio, John Hancock actively manages its fixed portfolio in its fixed insurance products. It's very unique as opposed to working on, let's say, their checking and account and reserves. So that's very positive. They also manage their own indexing and whatnot. If I'm talking out of school, let me know, because of their vast experience. With that, I'm going to introduce you to Dan Sullivan. He's our wholesaler, regional vice president. And Dan, take it away.
Neil, thank you very much. Good morning, everybody. And before I introduce our guest speaker this morning, I just want to kind of piggyback off of what Neil was saying with regards to what Hancock has been doing. And, last year obviously was a tumultuous year for a lot of insurance companies. And you saw that reflected directly in how they were managing their business. And to Hancock's credit, we really didn't skip a beat as far as our underwriting, how we manage our blocks of business, and our capacities, as Neil had mentioned. And that says a lot to how a company reacts in a very difficult environment. So, and in that environment, we had tremendous growth, not only last year, but in the previous years with Main Street Planning Group. And that relationship has grown over the years, but that really is a direct result of the consultative approach that Neil takes to the business and to your cases as they come in. And Neil and I are constantly leveraging the vast resources that we have at John Hancock, including our guest speaker, and building those underwriting relationships that help you get the offers we need. And that goes a very long way when we're talking about some of your larger cases, your smaller cases, but that success that you have is due in large part to everything that Neil, Carmen are doing for you guys behind the scenes. And I could tell you, this really has been a joy to work with Neil and Carmen over the last few years. And I'm not just blowing smoke because you're running the meeting, Neil. That is the truth.
Thank you.
And you know it because we talk almost every day. So with that being said, I'd like to introduce our guest speaker, Carly Brooks. Carly is AVP and Counsel, and she is head of the Advanced Markets Department at John Hancock. And today she is going to go through the 2021 post-election planning opportunities that John Hancock sees going forward. So with that, Carly, I'll turn it over to you and you could share your screen.
Great, thanks so much, Dan. And I just want to, say hi to everyone and thank you for your time this morning. Neil, thanks so much for having us on. We always appreciate it, and it's fun to get the opportunity to be back. So let me just share my screen. And okay. So hopefully you can all see my screen. All right, we can all see my screen?
Yes.
Okay, great. So looking at, Neil and Dan and I were talking right before we started today, and it's interesting. I think last year we saw really an unprecedented year in many different respects. I kind of thought coming into 2021, we'd have a little bit more clarity. I think we'll see that as the year progresses. But as of right now, there's a lot of unknown, a lot of uncertainties. But with uncertainty, I think a lot of times does come opportunity too for our clients. So for our time today, I want to take a few minutes to really unpack what those post-election planning opportunities look like. But also just really emphasize that I think that as we unpack what these changes might mean, I do think there's going to be quite a lot of opportunity for our clients in the high net worth space. And just want to make sure too, so you can see do you see my main screen, or is it the?
No, we see your speaker screen.
Oh, you do? Okay, I was worried that was the case. Let me swap that.
That's right.
That's better. Okay, great. So again, just looking at our update today, I want to spend some time just providing a Washington update. I think it's important to unpack what some of these changes have been, both on the tax planning side, as well as some other changes that have come down in the last couple of weeks. We'll then provide just a quick overview of the tax proposals, take a look at the planning opportunities. That's where I really want to spend a lot of our focus. And then just emphasize again that we can be your partner here at John Hancock in terms of providing a lot of different tools and resources and illustration capabilities. So in terms of a Washington update, we'll talk a little bit about tax proposals and tax uncertainties, but I sort of want to hit sort of what's been the elephant in the room, I think, in a lot of these calls that I've been having the last few weeks, and just spend a couple of minutes first talking about those changes to Code Section 7702. Code Section 7702, that is the code section that guides how life insurance products are tested under the testing rules for what qualifies as life insurance. Code Section 7702 hasn't been substantially changed in decades, really, and I'm sure that many of you, if you've been kind of following what's been going on in the news and on LinkedIn, and I've been seeing a lot of different things out there, but you may be aware that 7702 was changed as part of that Consolidated Appropriations Act, or the COVID bill that was passed right at the end of last year. So right around Christmas time, we saw this 550-page bill that was signed and passed. Tucked into that bill were provisions to amend 7702. It was a reflection of the continued low interest rate environment, actually a unique time where low interest rates actually help life insurance industry, and due to some lobbying, this was something that was first introduced last year, earlier in the year, and it did make it into that final bill last year. So the legislative changes, the provisions basically amend 7702 to change the fixed interest rate assumptions, which are 4% or 6%, depending on the type of contract, that are built into those life insurance determinations to rate assumptions that will be indexed based on current rates. So significant among those determinations are those for the CVAT and GPT testing. These new guidelines allow for alternative rates if lower. So it'll be either an NAIC rate tied to corporate bond rates, or a new rate derived from an average of midterm applicable federal rates. And so that's kind of good. That means a few things. So being now tied from rather a built-in fixed rate into product assumptions, now we are being tied into current rates, and the impact and opportunity of that, and most expected most significant expected effect of that will be to likely increase the maximum premium that's payable into a policy without triggering MEC treatment. So what that means is it may increase the rate of cash accumulation in some policies. So that's largely going to be good news, both for whole life policies as well as in the universal life space. And we'll have to see kind of what does that impact mean. But as it relates to accumulation sales and the life insurance industry as a whole, carriers like John Hancock, we're evaluating that impact. It's going to depend on what products you're using, what's the funding pattern, the design, the age of the client. But generally speaking, that should be, fairly, something to keep a close eye on, and likely will be good news as we explore that further. As I think about, again, like I said, we're working to incorporate those requirements as a company as necessary and report those developments. But from where I sit, I think the messaging for accumulation sales may dovetail with risks that we're likely to see to high income earners, that these high income earners who are facing potential increases in taxes due to legislative changes under the incoming Biden administration. So with that said, 7702, I guess for right now, as I see it, stay tuned. We're closely monitoring the situation, but the ability to potentially have increased messaging in the accumulation markets, I think, is going to play into our next point, which is really focusing on what's our planning environment now that we know a little bit more about what the makeup of Congress is going to look like heading into this year. So we speculated a lot last year on tax law changes and what that might look like. We'll talk a little bit about the Biden campaign proposals. Obviously, at this point, those are proposals. So what actually comes to fruition is still kind of anyone's guess. But after last week's runoff elections in Georgia, we do know that we have unified Democratic control of the White House and both chambers of Congress. That does make tax law changes appear more imminent. However, we do have very, very slim majorities and a 50-50 split Senate. So while there's still a lot of unknown, and I think we can expect to see certainly some changes this year, that slim majority is going to make compromise really important. And so the question I've been asked is, how quickly and to what extent are we likely to see tax law changes come down? To answer the how quickly question, I'd say, there's going to be a lot of competing priorities for the incoming administration. We're likely to see changes not only in tax laws, but also for retirement savings, healthcare, a host of other issues, not to mention the fact we're still in this global pandemic. So I do think it's likely we'll see some changes, but how quickly is going to depend on what's the biggest priorities for the incoming administration. To what extent, that's where things get a little trickier. Like I said, the new administration is going to be constrained by a Senate majority that's very narrow. They're not going to be able to afford any defections. So I think that with people that are more moderate or independent, the challenge of racking up 60 votes needed to overcome Republican filibusters will be quite challenging. As a result, legislation will typically either need to require support from either 10 or more Senate Republicans, or more likely find a way around those filibuster rules. For tax law changes, a way around the filibuster rules is through budget reconciliation, which does not require a supermajority vote, simply just a majority vote. In any event, still, I think slim majority is going to keep policy from getting too controversial. So we'll have to see some level of compromise. Really, the bottom line here is a lot of unknowns, but I think it's very safe to say that in the high net worth space, clients are going to be looking for not only estate tax efficiency, but importantly, income tax efficiency. And of course, as they're building out those plans and we're getting clients motivated to act, we're going to need to be building flexibility into those plans. My kind of action item for everybody listening, if it were me working with clients, this is what I would be doing right now, is trying to uncover, did clients make gifts to trust last year? So there was a lot of buzz about making gifts. A lot of the attorneys that I've worked with closely and spoken with have said, we talked about it, but it didn't always result in action. So I would want to be uncovering to say, did clients make gifts before year end? If they did, what's the trustee and planning team's strategy now for optimizing those assets that are owned in trust? So we'll talk a little bit about some strategies there, but that's going to, take a look at what types of options are now available for funded trusts. And if not, why is that the case? And I do want to take a few minutes today to just kind of focus on what we see as apprehension to gifting or apprehension to planning, and how we can take from what I would call planning paralysis in some cases to taking action. So we'll talk about both of those things today. So for the first kind of key point here, looking at who gifted to trusts, did high net worth clients make gifts last year? Do they have funded trusts? This is where we're really going to have to take a look and see if clients have funded trusts either prior to last year or as a result of 2020 planning. Now take a look at those assets. Could the assets in trust, do they have cash flow that could support a life insurance premium? What conversations is the trustee having with the planning team and the client with the planning team to talk about, are we optimizing those assets in trust? We have at John Hancock a way to illustrate this. We just produced new software that launched right at the end of last year on comparing gifting to a trust and investing in a side fund versus gifting to a trust and purchasing life insurance. And I think that sometimes just from a pure investment standpoint can be an interesting way to show the benefits of life insurance, of course, in addition to the income and estate tax-free death benefit that the trust would receive. So really honing in on the tax benefits of life insurance that will be owned in an ILET, looking at the income tax-free yield and what does that look like compared to the yield that the trustee could expect to achieve on other trust-owned assets. And then of course the liquidity that the death benefit provides, that's continually a conversation and a focus point and driver for a lot of clients. So for whether it's for estate tax liquidity or for equalization or for some other need there, I would really want to be uncovering, did clients make gifts to trust or do they already have funded trusts? What's their gifting plan? If not, but are they going to be leveraging those trusts? And I think there's a lot of opportunity there for clients. Where I think we're likely to see a lot of clients fall, though, is sort of in the later camp where, the latter camp where clients maybe had discussions about gifting. And I find this to be sort of an interesting psychological study, if you will, because if you think about clients who are high net worth, maybe last year, the pandemic had them thinking about protection needs, tax law uncertainty coming with a lot of political uncertainty. There was some economic uncertainty. I do think that generally speaking, clients last year were wanting to have conversations with advisors, but whether they acted on plans or not is really the key question here. So I think in some cases, clients were motivated to maybe pick up the phone and talk to their attorney or talk to their financial professionals or whoever the person was. But whether they actually acted on that, I think comes down to these three, what we call AAA. So it's age, assets, and attitude. Typically one or more of these three A's is what factors into whether a client will actually act on a plan. So I'll break this down and then we'll provide some ideas for how we can get clients to overcome these hurdles and lock in solutions that help to address what may be keeping them on the fence. So if you look at the age first, kind of at the top of the pyramid, the perspective of someone in their 40s is going to be so much different than someone in their 70s or 80s. One attorney I work closely with, he told me, I had a lot of clients, but my clients that are in their 30s or 40s, they can't fathom locking up $20 million in trust right now for their 2-year-old. So is the age perspective, that is very real. Somebody that's in their 40s, 50s, they might not be thinking about wealth transfer the same way that someone in the older ages may be. So thinking about how do clients' age impact their planning decisions. Secondly, assets. This one's really huge. What types of assets do your clients own? Obviously, when we look at net worth, that's one thing, but obviously, as we all know, when you break it down and really take a look at what assets do your clients own, that's going to impact not only their ability to act on plans, but their willingness to act on plans. So do your clients have assets that are difficult to value or difficult to transfer? Maybe they have transfer restrictions. Certain types of assets clients might want to hold on to for tax reasons. So, we'll talk a little bit about the proposals in terms of the potential elimination, the step up in basis, but I'm finding most clients, many times clients that have assets that have significantly appreciated, they want to hold on to those assets today. Maybe the clients have assets that have meaning beyond their monetary value. So things like heirloom property, or the big one would be family businesses. Age and assets typically factor into overall attitude. Do I want to do this? Do I have to do it right now? Those types of questions, that's really where, I think we're going to see a lot of people hesitating to plan because something in their plan is making them unsure if they want to do this. And this could be political, it could be economic, it could be their family situation. So a lot of different things factor into their overall attitude as they look to plan. The second idea here too is, placing the case now, deciding about gifting later. So for clients that, again, are unable or unwilling to make gifts quite yet, we need to find solutions that get the insurance in place now. So personal ownership might make sense if it doesn't seem feasible to get a trust done, or if you don't want to have a client that uses the trust right now. I'm talking a lot about the benefits of personal ownership. So looking at what we would call a survivor standby trust. This is something we've built out quite a lot of materials on in terms of allowing the client to own a policy personally and then opt to either gift or sell the policy at a future date to the trust. That's something that can work well for some clients. In other situations, leveraging the low interest rate environment and using financing options as a wait and see to gifting, that's going to continue to resonate, I think. And there's a lot of different flexibility there. And that's really where, again, we're going to match asset and age to attitude. So if you have clients who, again, are unsure about where they're going to fall in terms of the overall estate tax planning environment. So under the Biden proposals, we're predicting, he proposed to reduce the estate tax exemptions from an all-time high of where we're at currently, $11.7 million down to $3.5 million, as well as decoupling the federal estate and gift tax, potentially resulting in a $1 million gift tax exemption. So for clients that are really, unsure about writing that check today and making a gift, given that planning environment, I'm finding that leveraging the low interest environment and using financing as an alternative to gifting gives the clients the flexibility to get the plan in place now while we keep a close eye on what those campaign proposals could look like. And then with the idea that you can forgive the loan under the loan arrangement to decide at a later date to make a gift if we see tax law changes down the line or imminent. As we look at financing as an alternative to gifting, here's really where I want to look at, again, assessing the client's ability or willingness to make a gift. If you have a client who's on board with gifting, I think that gifting is often going to be still most simplistic. Again, in terms of the environment, there's been discussion, we had certainty on clawback. I've heard some practitioners talk about would tax law changes be made retroactive and how would that impact gifts? So say if tax law changes were retroactive to January 1st of this year and my client makes a gift on February 1st, how does that impact it? So if you have clients, again, that are unwilling to make a gift because there's still some unknowns there, leverage the low interest rates. What I want to uncover there is how much cash does the client have on hand? What types of assets do they own? Are there any restrictions that would prevent the client from transferring those assets in trust? So things like assets that are subject to debt, transfer restrictions on business interests that are pursuant to an operating agreement or buy-sell agreement. Those are some examples of restrictions. And once we uncover what types of assets the clients have and what's their attitude and willingness to engage in planning, that's then when we can start to look at potential solutions and offer solutions based on client profiles. So the key here again is whether it's a gift or a financing technique, we want to provide flexibility for the client. And then we also want to talk about the benefits of taking those transfer assets once they've been moved to the trust and using those assets to buy insurance. AFR rates continue to be at an all-time low. This is something that, as I look to see sort of where we're headed as an industry and where we're headed at, from a planning perspective, I think the low interest rate environment, the conversations are going to continue to be the same. A lot of the things that we saw last year and talked about last year, but I do think there's a little bit more urgency now because again, we have a new administration that's coming in. There's been speculation that, the Green Book proposals, as they call them, are always on the table of could things like GRAT terms be lowered or reduced under a new administration. It's possible. It's always something that's talked about. So if I'm a client, maybe I'm wanting to lock in a low interest rate now, or for GRATs, for example, lock in the low 75/20 rate now before it's too late. So I'm not really seeing clients doing as many rolling rolling grats unless they're of older ages, but for clients that are looking to implement one of these financing techniques, I think there's definitely an advantage to be getting in front of them early in 2021 before we see any tax law changes that could impact their ability to enter into these loan arrangements at the rates that they're at now. Looking at wait and see loans, you may have heard or seen some of our materials on this in the past. This is something that we've talked quite a bit about last year, and I think again it's just going to continue to resonate this year. So an option to build flexibility that comes into play is that when you have clients who are on the fence about initiating planning and they want added flexibility or control, that's going to come oftentimes through a financing technique. So in this climate, clients realize, again, there's a limited window before 2026. We've heard Biden and, through his campaign proposals, talk about reducing the exemption. So for those clients with those uncertainties, I think there's going to be a lot of people that, again, are just nervous to lose control. It goes back to that attitude factor I was talking about at the beginning. So for those clients, here we could suggest that they either make a loan to their trust. Alternatively, for younger clients, split dollar, private split dollar, I expect to see a lot there as well. Private split dollar loans with potentially a GRAT as a rollout functions very similar to making a lump sum loan regime split dollar type loan to the trust. The trustee takes the money that's been loaned to the trust, invests it. We assume that the trustee, the asset income can pay the premiums on the life insurance policy and the interest back to the grantor. Under the loan terms, the grantor gets repaid, but again, we have this flexibility and option to forgive the debt at any point in time if needed or desired. So looking at the numbers here, this is just a quick example of what that looks like. But if we assume the January 2021 midterm AFR rate of 0.52%. If a client wants to lock in that midterm AFR rate, 9-year note requires him to loan $4.3 million to the trust. We assume the trust asset generates income again at 6%. Is that reasonable? We dial that in based on your assumptions, but we have flexibility in how we design these. In this case, we're going to mirror the premium stream to the loan term. Doesn't have to be done that way, but I kind of like that because then if you opt to be repaid under the loan, there's no further premiums required. And it can make it more simple from an illustration perspective. So here we have the trustee that purchases the $10 million policy on the grantor's life with premiums illustrated over 9 years. And then that asset income is going to pay the premiums, which is approximately $220,000, and the loan interest, which is approximately $225,000. So just hypothetical example with rounded numbers. Just to illustrate what this point looks like. So forgiving the loan here, in a private finance, or this could also work for an asset sale as well. With an asset sale, there'd probably be some upfront gifting with a seed gift. But we don't really need to focus too much on the numbers here. I just want to point out that, we're showing a loan forgiveness here, 4.3 million. What that means is that if the loan is forgiven, and let's assume that it's forgiven prior to what's the current sunset date of 2026, at that point in time, the side fund is just going to continue to grow. It's not going to be redirected to premium payments after year 9. So then we have not only the $10 million death benefit, but we also have the side fund that's growing inside of the trust. So you have a total projected net to heirs. Here I put at age 93 of almost $37 million. So pretty substantial net to heirs. Just by making that gift. But the strategy incorporates flexibility to make a gift at any time. And is that built-in exit strategy. So again, given that there's a lot of uncertainty in terms of tax proposals and where we're at, repaying the loan, I think beginning in year 10 is also a potential option for a lot of clients. And this, like I said, could work well in split dollar context as well. So for high income earners, I think there's also going to be a huge focus on income tax planning this year. Looking at the proposals for high income earners, we've heard a lot of buzz on the fact that the Biden administration doesn't plan to raise taxes on those making under $400,000 a year. What that actually will look like, again, there's a lot of uncertainty there, but if we look at just the campaign proposals, the income tax rates for incomes above 400,000 were proposed to be increased from the current 37% to 39.6%. It was also proposed that long-term capital gains and dividends could be taxed at ordinary incomes above $1 million. There's a lot to unpack in the Biden campaign proposals in general. I would also, just kind of note that a lot of the things that have been proposed are planning to roll back the Tax Cuts and Jobs Act that went into effect in the beginning of 2018. A lot of those provisions are already planning to sunset in 2026. We could see tax law changes that move up the date on that, as some of these proposals indicate, but there's other things in there as well. But I think the real point to what these proposals mean for high income earner clients is that as income tax rates rise, the taxable equivalent yield on life insurance cash values and death benefits should become increasingly attractive to high income earner clients. So high income earners, I think, will be very interested in life insurance as a potential source of discretionary tax-free supplemental retirement income. Of course, with the death benefit and income tax-free death benefit being a component of that as well, both from an income tax and estate tax planning play. Potential opportunities, charitable planning too. We'll keep an eye on what types of charitable planning options will be out there, but charitable trusts and things like that, I think CLATs and the like will also be front of mind. So in the income tax planning space, I really want to focus on tax diversification with permanent life insurance and highlighting those living benefits and the options that are available to clients as living benefits. So managing taxes with life insurance, why would a client add cash value life insurance to their retirement portfolio? A lot of reasons. So retirement income from policy withdrawals and loans is not going to affect their overall income tax bracket. So that's really good, is that if we're doing planning now for downstream tax efficiency later, access to that money for your clients from a life insurance policy is not going to be subject to their income tax and affect their Medicare premiums, capital gains, or Social Security benefits. As I think we all hopefully are familiar, but I think, again, sometimes the things we know our clients aren't always as familiar with is to know to talk about the income tax benefits of life insurance. So of course, the death benefit, the abilities to accumulate cash on a tax deferred basis with the ability to access cash at any point in time, tax-free up to basis with, and also the ability to have tax-free access to death benefit for long-term care costs when a rider is added to the policy. So like I mentioned at the beginning, I think there's going to be a big focus this year on accumulation type sales, particularly when you factor in what we might see from those 7702 updates, as well as the Biden proposals and what types of tax law changes we see for high income earner clients. I think it's very reasonable to assume that tax diversification is going to be very front of mind and really important. Looking at tax diversification by age, I think this is important to break it down really from client profiles. So younger age clients, 50 and under, that's going to be your traditional supplemental income or LERP type design. High income earners would be the clients that are looking for downstream tax diversification and tax efficiency. The profile that I find to be really interesting, and I'll spend a few minutes to talk about this, are your clients who are closer to retirement age, 50 and up, I would say. And these are what we would call retirement backstop. So these are clients who are concerned about retirement risks. They are looking for tax diversification and efficiency, but looking more holistically at the risks they face in retirement and looking at how a life insurance policy can backstop against many of those risks. So we'll take a look at those risks, but I think where the opportunity lies in our current environment is to expand on the backstop story. So are we really honing in on the retirement risk of taxes and increased taxes during retirement years? How does that impact things like their overall their IRAs and other qualified plans that they have access to? Could we extend the life of IRAs by offsetting taxes on RMDs by taking withdrawals from a life insurance policy? Could we use potentially cash value to bridge the gap to age 72 for RMDs? So we saw under the Secure Act that clients can now wait to take RMDs until age 72 if they have an income need before that. If they have a life insurance policy that they can tap into, does that help to extend the life of the IRA? So backstopping retirement risks, And we have really good materials that break this down as well. But of course, the longevity risks, clients with a life insurance policy are really protected in what I would say 3 phases. So from day one, you have longevity protection. There's protection against sort of dying too soon, living too long, as we think about it, death benefit protection that can help to replenish assets for a surviving spouse or dependents. If long-term care type rider is added to the policy, that can be used at any point to help the client pay for long-term care expenses. If a client on the flip side lives too long and spends down their primary retirement assets, potential cash value can help to supplement retirement income in that situation. But really where I think it's a unique story is looking at all the benefits that permanent life insurance can offer to a client in addressing all of these different retirement risks. So last year, we really dialed down on the sequence of return risk. So what happens if your client retires in a down market? Does tapping into their other investments or retirement accounts, how does that impact the longevity of those accounts? It can be often very difficult to make up for down markets early on in retirement. Having the ability to tap into a life insurance policy can help to offset some of that sequence of return risk. Taxes this year, I think, will be a similar focus and key retirement risk, where having the ability to access cash value, income tax free, that's not going to be reportable as income, is going to be, I think, really huge for a lot of high earner clients. Other areas of expertise and focus, I think, this year, so the business planning focus, that's one kind of thing that I'm really focusing in on too. So last year we talked a lot about wealth transfer planning. Expect that to continue this year on the individual side as well. But don't forget about business owner clients. We have a lot of untapped opportunity in that space and resources on that. It's interesting because, again, with campaign proposals, we have seen the proposal to raise corporate taxes from 21% to 28% and reintroduce the corporate AMT. It's interesting because when we saw the tax cuts to C corporations back a couple of years ago, those were quote unquote permanent, meaning that they didn't sunset in 2026. But I think it's just another good reminder that what is permanent when it comes to legislation is not typically always permanent. So we could see substantial changes to businesses as that becomes important. We're going to see businesses looking for ways to use life insurance to help meet different planning objectives. So certainly in succession planning, as well as retaining and rewarding key executives, using the low interest rate environment for things like loan regime split dollar. We've built out a lot of resources and have some materials on there. Charitable planning I touched on briefly, but I do think that's an opportunity. And then we also have a lot of expertise in specialty markets like foreign national, and with our underwriting capabilities can be of assistance there for those types of unique cases and unique markets that are obviously more case by case basis. Looking at our tools and resources at John Hancock, if you want to find out more about sort of looking at what were some of the proposals, we do have our Central Intelligence newsletter where we really spend a lot of time going into great detail on a lot of the campaign proposals, as well as our most recent Hancock Talks podcast, which is another good resource that is a little bit more interactive in terms of breaking down what some of those proposals are. Our robust illustration capabilities within John Hancock Solutions, as I mentioned, with gifting, that module has been recently updated. That has a really nice way of comparing and contrasting gifting to a trust and investing in a side fund versus gifting to a trust and purchasing life insurance, as we look to weigh different decisions and options. Marketing, collateral, and educational resources. We're continuing to monitor a lot of these different changes as they come. Like I said, right now, a lot of the stuff right now is speculation. So we're keeping a close eye on this, and we've produced numerous blogs. As a follow-up to this call, I want to make sure, Neil, that we send to you our most recent blog on planning opportunities for 2021. It touches on a lot of the things that I talked about today, but again, pares it down to some of those campaign proposals and what that might look like. Short videos and webinar opportunities, that's something we can always offer. And just know that if there's no other takeaway, that we are a resource and partner to you. And we work very closely with Neil, and do really appreciate your time joining us today. So I'll open it up to some questions now. If anyone has any questions.
I have a couple questions. I'll just start with anything with regards to step up in basis. Where do you feel that will happen, not happen? And of course, taxation of life insurance. Everybody's always asking, is that still going to be protected? And just where are your thoughts? Of course, there's no guarantees of any of this, but.
No, I think the step up in basis has certainly been one that's gotten a lot of buzz. I think it's going to be interesting to see. I'm not as, convinced that we're likely to see that because, again, we do have really slim majorities. The slim majority in Congress is going to make that really difficult. But then aside from just even getting the votes to enact something like reducing this or eliminating the step up in basis, I think the real challenge there is also just the fact that administratively it would be quite difficult to actually implement that. So could it happen? Certainly, but I think that trying to track what those where we've been and have people been doing basis reporting, do they have that information? All those sorts of things. I don't know that everybody has done a great job of that. So I just think from an administrative perspective, it could be a real challenge. To do that. I think what we're more likely to see is a potential reduction in the exemption. So I don't know if we'll go down as low as what was proposed. Again, the $3.5 million. But that's something to keep in mind as well. So I think, could that be changed? Possibly. But it's hard to say. As it relates to the income tax buildup in life insurance, that's something that comes up often. It's funny because I tried to track this and see if I could find anything, really interesting to share on that. It comes up from time to time. I don't know that fits into the public policy of, I think life insurance as policy is really good. I think that I would be, again, I think that we should be keeping a close eye on it, but I'm not sure that I've really seen much that would indicate that we should expect the tax buildup in life insurance to go away anytime soon.
Gotcha. And I had one further question. 7702 gives us some unique opportunities. And what I was thinking is, and again, I haven't tested it yet, but it seems like you could put a lot more money into life insurance contracts without it mecking, which could greatly help on the premium finance module and whatnot of dumping a lot of money early on into policies and or regular, gifting of assets could be very helpful. But 7702 doesn't affect reserves at all, does it?
Not that I'm aware. No, it should. I'm not actually 100% sure. Dan, are you familiar with that?
Yeah, Neil, as far as I know, they've given us some preliminary detail here. They didn't mention impact on reserves. They did say that this is not impacting in-force policies. So I think it would apply to products filed after January 1st of this year. So, but we can find out about the reserve.
Right, that's definitely correct. It would apply to new policies. That being said, again, I think the full impact of what this means is going to come down a lot to the product, the client's age, the funding pattern, what does the case design look like? But to the extent that, depending on the answer to those questions, as we look to implement changes on a product side, I think that we may see opportunities in the replacement space, and there could be opportunities that come there. And then obviously for new sales, as we look to accumulation type designs, I think that could be something that we'll see there with high income earners over 400,000 being tapped in there. One other piece too for the income proposals that we've seen, there has been a proposal to expand the Social Security tax rate to 12.4%. So it's not just income tax rates. There's a lot of different things that I think will be coming into play and could be on the table as it relates to tax planning. So for people looking again, for that downstream tax efficiency that life insurance can potentially offer, I think those conversations are going to continue to be pretty important.
Excellent. Does anyone else have any questions regarding this? You covered a lot of material, Caroline. I mean, Carly, it's insane. But, you know, the time to plan is now, and to be proactive with your clients and let them know this is what's happening. The industry is definitely impacted. In the last 6 months, we've seen 3 or 4 major carriers leave the guaranteed UL market. So product is changing rapidly. We're going to see changes to the index market with 7702, with more people putting in more premium. So that's going to be a big change. And change is already in place. And again, we want to get our clients off the sidelines and into planning. I know Larry Shear, who had to leave the meeting, was very active this year in estate planning because of COVID. People are concerned. And they should be. And the time to plan is when you can, not after. Any other questions or thoughts? Or if not, again, thank you, Carly, and thank you, Dan, for supporting Main Street. And congratulations, Caroline, on your recent promotion of being lead advanced attorney at John Hancock. So,
Oh, thank you so much. Appreciate it.
Thank you, guys.
All right.
thank you.
Those follow-ups out to you, Neil, so you can send it to the group.
Thanks.
Of course. Thanks again.
Okay.
Have a great day.
Good presentation,
Good day,
guys.
everybody.
Thanks.
Thank you.